If you need this cash in a year or two, a bad market could shrink it right when you need it most. Safety beats greed on short timelines. Step 2. Automated. Set up an automatic transfer the day your paycheck lands straight into that house fund. If you never see the money, you never miss it. Saving on autopilot beats willpower every single time. Step 3. Attack your biggest expenses, not your coffee. Rent, car payments, and subscriptions move the needle far more than skipping a latte. Cut one big recurring cost and you might save more in a month than a year of small sacrifices. Step 4. Throw every windfall at it. Tax refunds, work bonuses, birthday cash, a side hustle payout. These are money you weren't living on anyway. Funnel them straight into the house fund instead of letting them quietly disappear. Step 5, and most people miss this one entirely. Look into down payment assistance programs. Many states, cities, and lenders offer grants or low-cost loans to help cover your down payment, especially for first-time and moderate-income buyers. First-time buyer programs are a goldmine too. And no, first-time often doesn't mean truly never. In many programs, it means you haven't owned a home in the last 3 years. You might qualify and not even realize it. Here's another door most people don't know is open. Gift funds. In many loan programs, family can legally gift you money toward your down payment, as long as it's properly documented with a simple gift letter. Help from family counts. Add it all up and the picture changes completely. Low-down loans, assistance programs, first-time perks, and gift funds can stack together. The wall you thought was 20% tall might really be just a few steps off the ground. Let me give you the turn. Stop asking, can I afford 20%? Start asking which loan and which programs fit my situation. That single shift moves you from feeling stuck to building a real, doable plan you can act on. Here's what to do this week. 1. Pick a realistic target home price and write down 3%, 5%, and 10% of it. Now you can actually see your real options instead of one scary number. 2. Open a separate high-yield savings account just for your home and name it House Fund. Naming it makes it real, and a dedicated account makes it way harder to spend that money on anything else. 3. Set one automatic transfer into it today, even if it's small. $25 a week still builds the habit and the balance. The amount matters less than starting. Momentum is what gets you to the closing table. 4. Spend 20 minutes searching your state's housing finance agency and your city for down payment assistance. This one free search could find you thousands of dollars you didn't know existed. That's an incredible hourly rate. Now a little permission, because you need to hear this. You do not have to be perfect or rich to own a home. You just have to be informed and consistent. Ordinary people buy homes every single day. You can too. The myth told you to wait years for a number you might never need. The truth sets you free to start now, smart and protected. Knowing the real rules is what turns a far-off dream into a near-term plan. Quick recap. 20% is not required. Conventional can be 3%, FHA 3.5, and VA or USDA even 0 if you qualify. 20% mainly just avoids PMI, which goes away later anyway. And remember the guardrails. Budget for closing costs of 2 to 5%. Keep your emergency fund intact. Leave retirement alone. Save in a high-yield account. Automate it, and chase down every assistance program and gift you can find. So tell me in the comments, what's the home price you're aiming for? And which down payment percent feels realistic for you right now? I read these, and your number might inspire someone else who's scared to start. If this cleared up the 20% confusion, smash that like button, subscribe for one simple money lesson at a time, and share it with a friend who's still renting. Your future home is closer than you think. See you next time. You found the house. You love it. Then someone says you need 20% down, and your stomach drops. On a $300,000 home, that's 60 grand. Suddenly, your dream feels impossible. But here's the secret. That 20% rule? It's mostly a myth. It scares millions of renters out of buying every single year. They think they're locked out, so they keep paying their landlord's mortgage instead of their own. Let's fix that today. First, what even is a down payment? It's the chunk of cash you pay upfront toward the home. The rest you borrow as a mortgage. So if you buy at $300,000 and put $30,000 down, you borrow $270,000. Why does that upfront cash matter so much? Because it does 4 powerful things at once. It shrinks your loan, lowers your monthly payment, cuts the total interest you'll ever pay, and instantly gives you equity, real ownership in your home. Here's proof the myth is just a myth. Conventional loans let many buyers put down as little as 3%. First-time buyers especially. That's not a typo. 3% on a $300,000 home is just $9,000. And it goes lower. FHA loans, backed by the government, allow 3.5% down with more flexible credit rules. They were built to help everyday buyers get in the door without a giant pile of cash sitting around. Want to know the wildest part? Some loans need zero down. VA loans for eligible veterans and service members, and USDA loans in many rural areas can let qualified buyers put nothing down at all. Zero, if you qualify. So if you don't need 20%, what does 20% actually buy you? One specific thing on a conventional loan: it lets you skip PMI. That's private mortgage insurance, an extra monthly fee that protects the lender, not you. When you put less than 20% down, you usually pay PMI every month until you reach about 20% equity. The good news? Once you hit that mark, you can often have it removed. PMI isn't forever. It's a temporary cost. Now, the real decision. A bigger down payment means a smaller loan, a lower monthly payment, less total interest, no PMI, and a stronger offer that sellers love. But it ties up your cash and it delays the day you actually buy. A smaller down payment flips it. You buy sooner, you keep more cash liquid and safe, and you start building equity now instead of years from now. The cost? Higher monthly payments, PMI for a while, and more interest over time. Neither answer is automatically right. It depends on your savings, your timeline, and how stable your income feels. The point is this: you get to choose. You're not forced into one number by a rule that was never actually a rule. Let's talk real numbers, the proof people skip. Surveys consistently show the median down payment for buyers sits well under 20%, and for first-time buyers, it's often single digits. Most people buying homes are not putting down 20%. Think about what that means. While you wait to hoard a giant down payment, your neighbors with 3 or 5% down are already owners. They're building equity and watching their home potentially grow in value, starting today, not someday. But before you celebrate, here's the trap nobody warns you about. The down payment is not the only cash you need at the closing table. There's a second bill waiting, and forgetting it can blow up your whole plan. Closing costs. These are the fees to finalize your loan and purchase. As a rule of thumb, they run about 2 to 5% of the home's price, and you pay them on top of your down payment, not instead of it. What's inside them? Things like the appraisal, title fees, lender fees, and prepaid taxes and insurance. On a $300,000 home, that could be $6,000 to $15,000 extra. Budget for it, or your closing day gets ugly fast. Here's a rule to burn into your brain. Never drain your entire emergency fund to hit a bigger down payment. The day you buy a home is the day surprise repairs start showing up. A broke new owner is a stressed owner. Same goes for your retirement. Rating your 401k or IRA to pump up a down payment can cost you taxes, penalties, and decades of compound growth. The house is the goal, but don't burn your future to buy the present. So how much should you actually aim for? A solid rule of thumb: save enough for your chosen down payment, plus closing costs, plus an untouchable emergency fund. That third piece is what keeps you safe after you get the keys. Now the fun part: actually saving it. Step 1. Keep this money in a high-yield savings account, not the stock market. Your timeline is short, and you can't risk a crash wiping out your house fund right before you buy. Why not invest it? Investing is for the long game, 5 years or more.